Welcome to another episode of The Intelligent Speculator, where our purpose is to provide insights into economic and market movements that have been successful in helping us grow our wealth. And now, let's hear from the hosts of our show, Jesse Sanders and Lathan Fritz.
Hey guys, I'm your co-host Jesse Sanders. In today's show, Lathan shares both how and why he plans to utilize inverse ETFs in the coming months to profit in the recession that he believes our economy is heading for. So let's jump right in. Hey Lathan, how we doing today?
Doing fantastic, Jess. What's going on in your neck of the woods?
Man, all is well here. Got a beautiful day outside, so no complaints on this end, man. In preparation for today's show, I've been listening back to some of our last podcasts, and I find myself fairly interesting. Hope I'm not putting others to sleep out there. Yeah. Well, one of the questions I had that I'd written down was a few episodes back. You mentioned ETFs and why you're looking to monitor ETFs and potentially speculate on some ETFs in the coming months. Could you explain to our listeners first kind of a basic understanding of what is an ETF or an inverse ETF, and then maybe we'll unpack a little bit as to how you're looking to speculate on that.
Oh, for sure. So an ETF it stands for Exchange Traded Fund. And basically, you can think of it like this. This would be a very simple example. You have a gold ETF that just tracks the price of gold. So when the price of gold goes up, that ETF increases in value. And if the price of gold goes down, it decreases in value. And the same could be said for almost any commodity. There's ETFs for like silver, oil, and there's also ETFs for stocks. So if you think the Dow Jones is going to go up, you could buy a Dow ETF, and it would go up as the Dow goes up, or it would go down in value as the Dow if the Dow depreciated.
So it's just tracking markets or commodities. It's just kind of a tracking mechanism. It's just following the prices of those commodities or stocks.
Exactly. And then you would have the opposite of an ETF, which is the inverse ETF. So going back to our gold example, in a gold inverse ETF, as the price of gold goes up, its value goes down, but as the price of gold goes down, its value goes up. And the same would be,
same thing, just opposites. So
exactly.
If markets are going up, this thing's going down. Okay.
Mm-hmm. Yeah, and really, they're financial tools that were effectively created so people could wager and hedge on certain positions. So if you were long something, long the Dow, but you wanted to kind of like limit your downside risk, you could also buy an inverse ETF on the Dow. The same if you were kind of long gold and you wanted to limit a significant decline in the price of gold, you could also buy an inverse ETF. So there's a lot that kind of goes into, from someone's perspective of what positions they hold and what kind of protections that they want to have on a decline of a certain, financial asset that they have. So, and in those regards, they would be looking at an inverse ETF.
A question that just jumped out to me. We had this, down here in Houston, Texas, or big oil country here. When crude oil prices went negative, I guess a couple weeks ago.
Yeah.
Was that, how the ETF market, how big of an effect did that have on that? Was that speculators? Was that kind of same thing? A lot of speculators playing in and causing some of that crash? Did ETFs have a role in that?
Well, to an extent, yes. But the real problem with why oil went negative was not necessarily the futures market. The futures market of oil didn't go negative. Even when it went negative, like down the road, I think it was still around like anywhere from $10 to $15 a barrel. But what the problem happened was for the spot, when somebody gets oil, usually they trade the contract off before they have to take delivery of it, because a commodity contract for a spot price, eventually somebody has to take delivery of the barrel of oil. The problem was you had no storage capacity because there was all this oil that was produced. All the people that were hanging on to their oil because nobody wanted it. It was because of the pandemic and because of our economic situation and the fact that economies were shut down. There was no, very little air traffic going on, very little road road usage for cars. So there's just no demand. So you had all these storage facilities filling up with oil, and then pretty soon these storage areas that settle the contract of physical delivery said, no man, like no, we can't take any oil. I don't care. And so at some point people are like, oh no, I have this oil, but I have nowhere to put it. And so at that point they're like telling people, here, I'll give you $5 if you take my oil. And so at that point, that's why it went negative, is because they were trying to pay people to take it off their hands.
Get it off their hands. Oh, okay,
Exactly.
So that makes sense. So it's not the ETFs. It's lack of demand created by everybody staying at home, not flying, not driving, and then no one wanted to buy that last position, actually take physical delivery of the oil because there was oil surpluses everywhere.
Exactly. Yeah. And
now
so
go ahead.
No, I was just saying, yeah. So it came up. The problem was just a lack of capacity to actually take the physical commodity to settle the contract.
Okay. Where now the ETF though, I guess from my understanding, and my understanding of kind of your predictions on the U.S. economy, that we are on the brink of a major contraction, potentially leading to a economic depression. Is this where an inverse ETF could play out in the equity markets? If you think we're at a high and things are going to get lower, would that be the opportunity, or would that be the ideal time for an inverse ETF if you think things are high and they're going to go lower?
Yes, and that's how you would play an inverse ETF. So, for me, I'm looking at, I believe we're currently in a bear market rally in the equity market. So the hit lows back in March, and they have steadily increased over the past couple of months. And once I think over the next couple of months, if I see kind of like a top where there's going to be a major sell-off, then me personally, I would be looking at like an inverse ETF on like the Dow Jones that I could put some money into. That would effectively be shorting the market. So it'd be the inverse related relationship. And again, yeah, like I'm not a financial advisor. I can't give any advice on what people do, but what I'm specifically looking for is kind of like that top in the equity markets for a time to pick up an inverse ETF for like the Dow Jones and the NASDAQ and the S&P.
And on those indexes as a whole, or on specific kind of baskets of stocks within those?
No, that would be just those specific ETFs that
Okay.
track it. So, because like I said, I think that the equity markets, the indexes, are going to decline significantly, as will probably, as I think, around maybe like 95% of stocks, which obviously with that much of a heavy weight on that many stocks declining in value, obviously the indexes get pulled down as a result of that.
Okay, so in this case, again, not as an advisor, just as in your personal opinion, if your belief is things are okay now, they're going to get a lot worse, the markets will go down. Again, we're kind of abbreviating a lot of other talks we've had, but if you think the bottom will be reached in 2 to 3 years and things start climbing, in theory, an inverse ETF makes sense now because you're making the play before it gets worse.
Mm-hmm.
Then at that same time, would the reverse also be applicable once it bottoms out? So 2 to 3 years, equity markets are at an all-time low, or a significant low, and they start to climb back. Would you then be on the flip side? Would you go into ETFs, or would there be a different play?
Yeah, I mean, it's technically, yes, you could go into a, just a normal, Dow or S&P, NASDAQ ETF that would increase as the index increases. However, I'm not really that interested in kind of like the capital gains or trying to rely on just stock prices going up. What I'm looking to do is buy very specific companies that I consider high quality companies that will be at bargain prices, that will pay very high dividend yields regardless of what their stock price does. And so that means regardless of what their stock price is, you're getting a check every quarter. And that is more specifically what I'll be looking at when I think the market's kind of when this bear market's running out of steam, and we start finding a bottom, that's what I'll be looking at, is going into very specific stock options, as opposed very specific stock picks, as opposed to just the index as a whole.
Okay, so this first approach here may be more of a short-term perspective, in that, hey, I think things are going down. I'm gonna potentially, I'm monitoring some of these inverse ETFs. Once it bottoms out, you're not always trying to kind of play the rises and falls of the equity market. You would then see at that time, once it's at a bottom, now I've got a really unique opportunity to pick some stocks and some companies that I think will be great long-term holds, buy them and hold them. That's kind of the difference between why you would do an inverse ETF now and would prefer to be more of a stock picker here in the coming years when this thing starts to rise back. Would that correct?
Yes, exactly, Jess. Yeah.
Okay.
You hit the nail on the head with that one.
There we go. Just making sure I'm getting the full picture here.
Yeah. So it's just one of those things where, an inverse ETF is a very good, in my opinion, for me, might be a really good, short-term play. And by short-term, next 12, 24 months, depending. And there's a lot of factors that go into kind of like me kind of seeing the price action on when it's a good time to go into it and stuff like that. But yeah, when things start bottoming out, like, I believe you're going to find great companies at great prices. And, that's what I want to pay a really kind of I want to pay discount dollars on great companies.
That's great. Well, man, I appreciate you taking the time explaining some of this stuff. I enjoyed discussing it, and am looking forward to kind of monitoring some of these things here in the coming months to, as we see some of this stuff start to play out. So I appreciate the time.
Sounds good, brother. Take it easy, Jess.
Thank you for listening to this interview with Lathan Fritz and Jesse Sanders. We hope to see you next time, and remember to like and follow The Intelligent Speculator on Facebook, Twitter, and Instagram, where we are posting insightful nuggets of economic and market movements. And if you would like to get exclusive information, feel free to join the Intelligent Speculator Facebook group. Good day.